When you work a normal job, the equation is straightforward. You trade your time and labor for a salary, and before that money even hits your bank account, a portion is siphoned off by the government to cover income tax. Yet for those at the top of the economic ladder, the connection between building a fortune and paying taxes often breaks down. These advantages are a feature of a tax code that treats the sale of labor differently than the ownership of assets. Billionaires rarely live on taxable income. They survive and thrive by holding assets, and they extract cash from those assets using a strictly defined three-step strategy: buy, borrow, die. These three words represent the primary mechanism used to grow and shield modern generational wealth. A cash salary is stagnant. $100 today is $100 tomorrow. But purchasing an asset, whether it's commercial real estate, private companies, or corporate stock, means holding a vessel that can multiply in value over time. Consider a founder who owns $10 billion worth of stock in their own company. Over a decade of successful operations, the value of that company skyrockets, and that individual stock portfolio doubles to $20 billion. Under current tax law, that new $10 billion in wealth is classified as an unrealized gain. It is strictly profit on paper. Unless the founder decides to sell those shares, the IRS cannot touch a single cent of that growth. By refusing to liquidate their holdings, the ultra-wealthy keep their expanding net worth inside a legally protected, tax-free vacuum. But this presents an obvious logistical problem. If you never sell your stock, how do you pay for the mansions, the yachts, and the day-to-day lifestyle of a billionaire? The answer is leverage. Instead of cashing out their shares, they approach financial institutions to borrow hundreds of millions of dollars against the value of those very assets. This diagram shows how the mechanics play out. Banks are eager to lend money to a billionaire because that massive $20 billion portfolio acts as secure collateral. Because the risk of default is low, the bank offers minimal interest rates. Here is the critical mechanical advantage. Borrowed money is debt. It is never classified as income. That means a $500 million cash influx lands in the billionaire's bank account without triggering an income tax bill. Even with the loan accumulating interest, the math heavily favors the borrower. The underlying stock portfolio continues to grow at a rate that typically outpaces the interest owed to the bank. The end result is a highly efficient cycle. The billionaire extracts massive amounts of liquid spending cash without paying income tax, all while their total net worth actively continues to compound. This cycle of borrowing can be sustained for decades, which leads to the final question. What happens to the massive unpaid loans and the billions in unrealized gains when the billionaire eventually passes away? When the estate is transferred to the next generation, the heirs benefit from a specific provision in the tax code known as the stepped-up basis. Instead of inheriting the purchase price, the asset's taxable value instantly resets to market price. By stepping up the basis, decades of capital gains vanish. If heirs sell the assets, they owe zero capital gains tax on that historical growth. It is an effective mechanism for wealth preservation. Entire fortunes built on a lifetime of market growth are handed down without the burden of taxes. Supporters of this framework argue it is a legal reward for long-term investment and the risks associated with starting and growing massive enterprises. Critics, however, point to a divide in the system, one that taxes the bi-weekly paychecks of ordinary laborers while offering vast exemptions to those who hold their wealth in assets. The debate highlights a stark reality. The financial economy operates on different rulebooks depending on how your wealth is structured. For the working class, survival requires trading labor for a taxed income, but for the ultra-rich, the strategy is acquiring assets and never selling. In a system where income is taxed, but asset-backed debt is not, the most efficient way to grow a fortune is to stop earning a salary and start leveraging the assets you already own.